Okay, when it comes to redeploying existing assets into a PLI program, I like to use this very technical demonstration of how the mechanics can work. And you're going to see here in just a moment. Okay, it's not that technical, it's a pair of pants, but I think this works best for you to understand the point. And really what I want you to take away from this is when you move money from existing assets into a PLI program, it really is just like moving money from one pocket to another pocket. And here's what I mean by that. Let's just say for a moment that somebody has $100,000 sitting in a money market. And I know everybody's situation is different, but just for the sake of simplicity and using round numbers, let's use 100 grand. And let's also say that this money market is a great one and it pays a full 1% annual interest on whatever's in the money market. So if that were to happen, what you'd have here is you have an inflow of $1,000 of interest, which would be great for something that's guaranteed, FDIC insured, and all that. However, you don't get to keep this full 1% because this type of account is in a fully taxable environment at your ordinary rate each and every year. We're going to have to pay some tax on that. So if we just use a round number, let's say after paying state and federal tax, let's just use $350 here. Now, after we pay our tax of $350, well, what are we left with? Well, we're left with $650. However, if we combine this with another strategy that a lot of my clients have when they come to me and also include some term insurance, and let's even just say for a second that this term insurance only costs them $700 a year. Well, you can see now all of a sudden by doing this, we're at negative 50. Our positive 1,000 actually went to negative 50. So we actually have a negative return on these combined strategies. All that said, one of the things that you can do is simply by moving this money from one pocket to another pocket. And again, you can't do it all at once without losing some key tax advantages. But let's just say we did this over the course of 5 years. Move this $100,000 over, and let's just say we did it at a clip of $20,000 a year, right, times 5 years. And at the end of the 5-year period, or sometime close to it, our full 100,000 was there. Maybe it actually was more than that. It picked up some friends along the way. Maybe it was a little less. What I can tell you can expect from this is it might be a little more or a little less after about 5 years, but we find on average there's a break even around the 5-year period. Everybody's situation is going to be different. We can't guarantee it. But again, when we go and look at numbers, we'll find that we're going to hit this break even period somewhere between year 3 and year 7. So let's just say for a moment, the full 100,000 is there. Well, let's see what other benefits we picked up simply from moving money from one pocket to another pocket. Well, one is we now have the opportunity to earn a better rate of return each and every year. And if we choose the type of policy that gives you a guaranteed floor of 0, well, some years you might earn 0, some years you may earn double-digit rates of return, which can be very nice. And also, so if it was over in this other pocket on that growth, we'd have to pay some tax. We also may not have to pay for term insurance or as much term insurance. So simply by moving money from one pocket to another pocket, what we get to do is we get to cut out some of these eroding factors out of the model. And so when you look at the strategy as a whole, if you can accept for the first 5 years, 3 to 7 years, it's going to be about a break-even strategy. But thereafter, you have a much better opportunity to pick up some growth. You get to cut out the tax man on that growth. And you also get to cut out some of those term insurance costs. A lot of my clients really enjoy this.